Next topic is special provisions. In special provision, we'll see that what type of transactions and how the taxability will be done if there is a related party transaction, right? Second, if there is a no capital loss, how we will consider it. If there is a NOL, net operating loss, right? Then what are the adjustments that we are going to do? So these are the three type of special provisions, and then we'll move to the special deductions. Okay, so first let's start with the special provision first. If a corporation is using accrual method, right? In accounting we use, if the corporation is using accrual method of accounting, and if that corporation is going to pay interest or some business expense to a related party, the related party is using cash method, then what the related party will say, see, corporation will take deduction as and when the corporation is going to pay to the related party. But what the related party will say, since I am using the cash method, as and when, see, not as and when they will pay, as and when it is accrued, the interest and business expense, as and when it is accrued. For example, it is accrued in December, the corporation will take the deduction, right? But the corporation is going to pay that interest and business expense in January month, right? So the related party will not tax that income in that year, but in next year. So here there is a loophole. That's why what the IRS says, whatever interest or business expense the corporation is going to pay to a related party, and if the related party is using cash method, then it will be deductible only when paid by the corporation to the related party. Means on accrual basis it will not be deductible. Whenever they are actually going to pay it, at that time only the corporation will get the deduction, because since they are going to include in the income only when they are going to receive it. So IRS is saying, as and when you're actually going to pay, actually you're paying that to the related party, then only it will be taxable. Then only you'll get the reduction, since they are being taxable at the time of payment, at the time of receiving. Got it? So as per the corporations chapter, what is the definition of related party? Related party means any other corporation who is the member of same control group. Do you remember control group we did? Affiliate group, do you remember? A, B, C, D, 4 types of group were there, right? So A and B will be related if in total more than 80% is held by a parent corporation. So A, B, C, D, all the 4 will be related party, will be considered. And if A is making any payment to the B, and if they both are using a different accounting method, I can say, then on the basis of cash basis, it will be deducted as and when it is actually paid. Got it? So yeah, here it is. Yes. Second definition of related party includes is individual who is owning more than 50%. It is but obvious that if they are owning more than 50%, then they will be considered as a related party. If it's a trust or fiduciary who is holding more than 50%, if it's a S corp, right? We are yet to do this chapter, but just remember, if you are a S corp and holding more than 50%, right? More than 50% is held by you, means the individual, more than 50% held in the S corp, and that S corp is related to the corporation, then you can say that that is a related party relationship. In partnership, if you are a partner for more than 50% or 50% in the C corp, C corp is there, here partnership is there. I am a partner for more than 50% and also I am holding more than 50% in the C corp. So I can say this C corp and the partnership are having a related party relation. Okay. Next is ownership stock. If the we have right now talking about 50%, 50%, 50%. So what does this 50% includes? Corporation, partnership, estate, trust will be treated as owned proportionally by the shareholder or the partners or the beneficiaries, right? Next, if you are a family, means in this definition, family definition, brother, sister, half brother, half sister, lineal descendant are only included. Now you can see here, mother and father is not included. Okay, in case of family, Ancestor is also not included. Yesterday only I told you what do you mean by ancestor. It means your grandfathers, forefathers, I can say ancestors. Linear descendant means what? Who are your grandchildren's? Children, grandchildren's are your descendants. Father, forefathers are your ancestors. So mother, father, ancestors are not included in the definition of family. Again, while calculating the ownership stock, we'll see that any three categories are there or not who are holding collaboratively holding more than 50%. Okay. Any individual owning stock in the corporation is treated as a owning stock by that individual partner only. Okay. So this was a simple definition of related party, and this is a simple provision. Whenever they are using a different method of accounting, right, accrual of the cash, it will be allowed only on the cash basis only. Means as and when actually it is paid, not as and when it is accrued. Next important special provision is capital loss. Okay. If you're incurring a capital loss, it can be used to offset the capital gain and not the ordinary income. See, if you have incurred a capital loss, it cannot be offset against the ordinary income, right? You should have a capital gain to set it off, right? Set off, I can say. Offset, set off, see. Capital loss can be deducted only up to the amount of capital gain. Whatever is the excess remaining, apart from that, whatever is the excess remaining, that can be carried back for 3 years and it can be carried forward for 5 years. This happens only in case of C corporation. Got it, guys? Whatever is the excess, they can carry back for 3 years, carry forward for the 5 years. There can be one MCQ from this topic. Taxpayer cannot combine it with the capital loss carry forward in the another year. Means what? See, you have to keep it separate only, right? Because 5 years is the maximum which it can be carry forward. So for example, I am having in 2018 I have a capital loss. It is carry forward to 2019. In 2019 there is no capital gain, so again it will be carry forward to 2020. Again there is no capital gain. Then there is the 2021. There is a capital gain, capital loss of 2021 and capital loss which was carried by 2018. So you'll first set it off this 2018 loss against this, and then this will be set off, and if there is any remaining, then that will be again be carried forward for the next 5 years, from which we will calculate from 2021. Like FIFO method we will use whatever is the oldest, whatever is the oldest loss will be set off first. Okay. If carries capital loss for 2 or more years, on the same years it's written over here, FIFO method will be used and deduct the loss which was earliest year. Taxpayer cannot use carry back or carry forward loss to produce increase in net operating loss. See, now what do you mean by this? 9. If you are already having a NOL, net operating loss, means all your ordinary incomes minus all your expenses, then you come to a figure which is a net operating loss. To increase this net operating loss, you cannot take capital loss into account. Means in simple language, if I say the year in which there is a NOL, you cannot take capital loss in that year. It has to be mandatorily carried forward to the next 5 years, right? And it will be set off in upcoming years when there is a gain. Got it, guys? Next is, now what do you mean by net operating loss? How it will be set off? Net operating loss, if you have incurred a NOL before 2018, the rule was it will be carried back to 2 years and it will be carried forward to 20 years only. Maximum 20 years, carry back to 2 years. If the loss is related to 2018 and 2020, then carry back is allowed for 5 years instead of 2 years. And carry forward is allowed for indefinite period. And maximum set off means whatever is we are carrying forward, we can set off the whole 100% loss in current year. Okay, if there's a gain, then we can, if there's a profit, if there's a net income, we can set off that carry forwarded loss in the current year, whole 100%. Now, what happened after 2020, the rules changed. We cannot carry back the losses. We can just carry forward it for indefinite period and instead of 100% we can set off only 80% of the loss. See, if for example I have carry forward the loss of say 1 lakh, in next year I have a 5 lakh of income, I can set off this 1 lakh, yes, but only up to the 80% of this loss, right? Means only 80,000 I can set off. So whatever is the remaining loss, whatever is the remaining 20k, this will again be carry forward, because carry forward is indefinite. Got it? How we will see that there is a net operating loss? We'll just take the gross income, we'll reduce the deductions and expenses and everything. Then we'll receive a negative figure, that is called a NOL. If there is a NOL, remember this thing, this is very important. I'm going very slow on this topic. If there is a NOL, net operating loss, then few things will be changed. Okay. First, we discuss this right now only. Few things will be changed. Just a minute. Yeah. If there is a capital loss and in that year there is a NOL, then it cannot be offset against capital gain. Even if there is a capital gain, it will have to be carried forward, right? It will have to be carried forward to the next years. Okay, if there is a NOL, net operating loss, the capital loss cannot be settled off. Okay, if there is a NOL and since last 2 years or 3 years, I'm carrying forward the other year's NOL, it cannot be used when NOL tax year. See, NOL will, obviously, the previous year's NOL cannot be set off if current year there is again NOL. So these 2 points are clear, okay? Then these 3 points we will understand once we do the special deductions. If there is a casualty or theft loss, then there's no rule that we are not going to take it into account or we are not going to include it, but simply we'll include it, we'll take the deduction. For if there is any casualty or theft loss, we'll take it in that year only, even if there is a NOL. Okay, so these 3 rules are clear. We'll come to these 3 rules, okay, once we do the provisions, special provisions, which I guess special deduction, which is the next topic. Okay, I'll come back to these 3 rules when I explain that. Next is special deductions. It might happen that the corporation is receiving dividend and also paying dividend. So there is a dividend received deduction which the corporation can claim. Okay. Second type of deduction will be related to a charitable contribution. If the corporation is making any charitable contribution, then what will be the limit for that contribution which will be allowed as a deduction for the corporation. So these are the 2 types of special deduction. You have to remember it. It's very simple topic and easy to remember. Okay. Step 1. If you have a dividend received deduction calculation in your question, you will do it in a stepwise manner, just as shown over here, right? Step 1 is identify your ownership in the corporation from which we are receiving the dividend, right? If my ownership is up to 20% or maybe 20 to 80% or more than 80%, we'll just apply this in the table over here. Okay, if my ownership, whose ownership? Corporation. See, I am a corporation. I am also holding some percentage of share ownership in some other corporation, and in that corporation, if I am having a ownership of up to 20%, then how much will I receive a deduction? Whatever dividend I will be receiving from that corporation, I can take a 50% of that dividend as a dividend received deduction in my books. If I'm holding more than 20% of share and up to 79%, then I can take 65% of the dividend deduction. Okay. Next is, if I'm having 80%, holding more than 80% of the ownership, then I can take whole 100% dividend as a dividend received deduction in my books. Right. Now, you remember we just left this topic over here, this one. So now here is the exception to this rule. After taking this deduction, if the taxable income, no, while taking this deduction, if my taxable income is less than dividend, right? If it's less than the dividend, then what I'll do, I'll use the percentage on taxable income instead of dividend. I'll just use the percentage on taxable income instead of dividend. Taxable income will include dividend income. Okay? Taxable income will include dividend income, and after including that, just see whether your taxable income is less than the dividend, then I'll just use the percentage on taxable income. See, instead of this dividend, it will taken as taxable income. If my taxable income is less than the dividend. Got it? We'll see one example, then you'll understand. Just remember stepwise. First, we'll identify the share or what ownership share we are holding in the corporation. Second, we'll apply the ownership rule, that how much ownership I am having. According to that, I'll decide the percentage, what percentage of deduction I am going to get. Okay. Third, I'll see whether I have to apply this deduction on dividend or on taxable income. So how you will see, there's one formula. Identify if any exception to this, means what? Tax. We are just calculating whether to apply this 50%, 65, 100% on taxable income or on the dividend income. Okay. So what you will do, you will make this type of table. If maximum potential deduction, see, if there's a loss, then maximum potential deduction will come into picture. If it's a no income, if it's a taxable income, it's a profit, then deduction is based on taxable income. If it's a loss, then deduction is allowed, maximum deduction is allowed, that is dividend into percentage. See, let's take one example, then only you'll be able to understand. If a corporation is having a loss of say 40,000, all right, it's a loss, and the corporation is receiving dividend of 1 lakh. So remember I said include this dividend into this. So loss plus dividend. So net, I can say net income is 60,000. What I'll do, I'll take both the scenarios. I'll just apply this rule. See, the corporation is owning 20% and the limit is 65%. Okay, so for 20% ownership, the limit is 65%. So what I'll do, I'll apply the 65% first on taxable income, and see, 60,000 is my taxable income. You know now how the 60,000 we came, right? What was our loss? It was 40,000. We'll include our dividend income into it, right? And the net income is 60,000 after reducing the loss from the dividend. 60,000, on that 60,000 we will apply 65%. Second thing, we'll apply 65% again on the dividend side, right? 10,000. See, here you can see after setting of this, if this figure is in positive, then when you apply this two formulas, you have to take whichever is higher and reduce it from this 60K. So here whichever is higher is 39 or 65, whichever is higher is 65. Got it? Simple. Just remember, see, it is very easy once you understand the concept. Once you understand how the flow is going on. First, what you will do, whatever is the corporation loss, we'll add the dividend. See, if dividend is not added into it, now then we'll add it, of course. Okay. So corporation loss plus dividend received, we will add it. We'll get one amount. If this net income is positive, then we'll apply these two formulas, and whichever is higher we will take as a DRD, dividend received distribution or deduction. Got it? What are the two formulas? We just apply the limit for C, what is our own ownership percentage. Then just check this table whether it's 20, less than 80 or more than 80. Then we'll take this percentage. So in our scenario it is 20%. Okay, so it is 20%, so I'll take 65%. I'll apply that 65% on taxable income and on the dividend income. Whichever is the higher, I'll take it as a DRD, and this will be the loss which I'll take. Got it? Now let's take second example where this amount will be negative. Okay, let's see. If my loss, the corporation is facing a loss, is having a loss of say 15,000. Okay, 15,000, and I have also received a dividend on the other hand of say, this is not 1 lakh, it's 10,000. Okay, say 10,000. Sorry, it's 1 lakh only. Here it is. Here it should be 1 lakh. Okay, 1 lakh I have received the dividend. So here what is the taxable income? Minus 15,000 plus 1 lakh, it comes to 85,000. Okay. So what I'll do first, since my ownership is 20%, I'll take directly 65% as a deduction. That is 1 lakh into 65%. So 85 minus 65. So it comes to 20K. Here it's positive, right? Here, what was happening? Let me show you this thing in a very clear manner. Wait. See, here 40K is my loss plus 1 lakh I'll add. Out of this 1 lakh, if I take the whole 65 on this dividend, I'll reduce 65K. So what will be the amount? Okay, whether it will be positive or it will be negative, it will be negative 5K, right? This is negative 5K. Remember this thing. See, again I am repeating, calculate it in this manner. I'll just take 40,000, that was my loss. I'll add dividend, that is 1 lakh. I'll reduce the DRD based on this dividend only, that is 65,000. So whatever is my amount remaining will be negative. If this is negative, okay, I'll apply this rule and take whichever is higher. Got it? Initially we had a confusion, we just considered the 60, but out of this 60 now we have to reduce the DRD, which is 65,000, right? 65% of 1 lakh, we'll just reduce it. So we come to a figure that is negative 5,000. So we'll just compare these two amounts and whichever is higher we'll take. All right. In next example, what is happening? It is positive. Next example, what is there? See, there is a loss of 15,000. What we will do, we'll include 1 lakh as a dividend. Out of this 1 lakh, we will reduce DRD, which is 65,000. So by reducing this and adding the figures, we receive an amount of 20K, which is a positive. If it's a positive, what we'll do, we'll again do the same calculation and whichever is lower, we will take. What calculation we'll do? We'll apply the 65% on taxable income. We'll apply the 65% on dividend income. Got it? So our taxable income was how much? Before taking this reduction, before taking this DRD, our taxable income was 85,000. 85,000 into 65K. Second, on dividend, we'll apply it on dividend. So 1 lakh into 65K. Whichever is lower, right, we'll take that as a DRD. We'll take that as a DRD. Got it, everyone? Next important topic is charitable contribution. See, DRD is clear, guys. This is important topic. At least 2 questions will be there from this topic. So mark it as A category. See, whole corporation and partnership is a A category chapter. Almost 65% questions will be included from C corporation, S corporation, and partnership. So that's why I'm taking this chapter at the initial only, right? Let's move on to the charitable contribution. If the corporation has made any charitable donations or contributions, I can say, then how much deduction will be allowed? Deduction allowed will be 10% of taxable income. See, here it is taxable income. Okay, if it's a non-cash property. If the contribution is for non-cash property, then I simply have to compare that whatever is my taxable income, I just take 10% as a charitable contribution in my books, in the tax return. If I have made a cash contribution, then 25% of my taxable income I can take as a deduction. Now you'll say, what about the excess contribution which we have made? Are we going to get the deduction or not? Yes, whatever was disallowed in the current year, it will be carried forward for next 5 years only. 5 years. Remember the limit, it's just 5 years, not indefinitely. Okay. If I talk about NOL, we remember net operating loss, it was carried forward for indefinite period. If I talk about capital loss, it was carried forward for how many years it was carried forward? If I talk about capital loss, it was carried forward just for 5 years. So capital loss, charitable contribution, CC, just remember like this. It will be carried forward for the just 5 years, right? And NOL, it will be for indefinite period. Now you remember, see, DRD we saw, DRD, we had a different calculation. If we have a negative figure, then we will calculate 2 scenarios, and whichever is higher we will take. If it's a positive scenario, positive figure, we will calculate again 2 scenarios, and whichever is lower we will take. Okay, so this is done. Next is if we had a charitable contribution, and in that year also we had a NOL, no deduction for charitable contribution in the loss year. If we had a loss and in that year only we have made a charitable contribution, then this 10% and 25% will not be allowed to be taken as a deduction in that year, but it will be carried forward, right? It will be carried forward for the next 5 years. Got it? About DRD, charitable contribution. Now, while calculating this, taxable income, what things you have to consider into mind? What things you don't have to, include? You will just exclude the deduction for charitable contribution. Taxable income. What is taxable? Income minus expense, minus deductions, I can say. So in this deduction, I'll not consider charitable contribution. In this deduction, I'll not consider DRD, right? Any NOL or capital loss carry back, I'll not consider. Deduction allowed under section 249, premium on bond repurchase. If there is a premium you have paid on bond repurchase, then they get a deduction in section 249. That will also be not considered. So if these things are mentioned in the question, just remember to exclude it from the deduction, right, while calculating the taxable income. Got it, guys? How we are going to calculate the charitable contribution? We'll just exclude these 4 items, and then we'll come to a figure that is called as taxable income. Based on the taxable income, we'll apply the percentage looking at the nature of the donation, whether it's non-cash or it's a cash. If it's a non-cash, we'll directly take 10%, right? And if it's a cash, we'll take directly 25%. All right. Next is charitable fee. We have seen what is taxable income, right? Now we have to see what is charitable contribution. Charitable contribution will exclude if, now remember this thing, this is a bit complex line written over here. If it's a non-cash property, means I'm talking about this, the 10% deduction. If it's a non-cash property and if we sell it for FMV, then what will be the ordinary income? We just have to see that if instead of donating it, if we sold it in the market, then what will be the income? Like what will be the STCG or maybe ordinary income? Whatever is the amount that we are going to incur if we sold it in the market, that amount will be reduced from the charitable contribution amount. I'll repeat myself, guys. Understand this thing. If it's a non-cash property, instead of donating it, if I would have sold it in the market, then what would be the gain I would have incurred? Like I would have gained instead of donating it. If I'm selling it, what will have been the gain? That gain amount will be reduced from the contribution amount, right? And then we come to an amount. That amount or 10% of the taxable income, whichever is lower, will get the deduction. Got it? See, this typical question will not come in the exam, but you should know the concept that what if non-cash contribution is done, right? And the property is contributed, then how this FMV will be affected, like, or else everyone will instead of what will happen? Everyone will just contribute make the donation of the non-cash property to save the capital gain taxes, right? But the deduction will reduce the gain which we are going to incur if it is sold in the market, and whatever is the remaining amount, only up to that extent will get a deduction for making a donations or contributions of a property. Okay. LTCG, if property sold for FMV, will be reduced from contribution of tangible personal property used by the exempt organization, contribution of any other property which is used by the private organization, contribution of any patent, trademarks, name, trade secrets, know-hows, or softwares or similar property, application of registration of such property. Okay, so don't need to remember this thing, just see this was, if it's a short-term capital gain, we'll directly reduce it. If it's a long-term capital gain, it will be reduced based on 3 scenarios. If it's a contribution of tangible personal property, what do you mean by tangible personal property? It's a movable properties which is used by the exempt organization, right? And if it's a contribution of any property which is used by the private foundation, donating it to the private foundation, and if it's a contribution of any patent, copyrights, trademarks, trade names, trade secrets, know-how, software, or similar property, or application or registration of such property. Okay, no need to remember this. There is no practical question or MCQ from this topic, but just to understand the concept. Okay. Contribution, see, corporation may claim a distribution. How much they can claim? Basis of donated property plus half of appreciated gain if sold. See, here we calculated that if it's sold in the market, then there will be a gain, right? So half of that will take plus basis of donated property, or 2 times of the basis of the property, whichever is lower, the corporate can claim as a distribution. And it will be taxable maximum 10% or 25% of the taxable income. 10% if it's a non-cash, it's a cash, and it's 25%. Understood, guys? Charitable contribution very well. Okay. Next is deduction may be allowed for certain contribution. How the deduction will be allowed? If I am making a donation for inventory or other property, and that property solely and wholly, see, remember this thing, there might be one question from this theory. Okay, so mark it as A. If that contributed property or inventory is used solely for the care of ill or needy or infant, then the deduction will be allowed full. Then scientific property, if it's a scientific property and contributed and donated no later than 2 years, right? I have taken a scientific property, did some research work, but within 2 years I have contributed it, then I can get the deduction for that property. Then there's a computer technology equipment acquired or constructed or donated. See, if it's a scientific property, the limit is 2 years. If it's a computer technology equipment acquired, constructed, and donated for like up to 3 years, within 3 years from the purchase date, if you are, donating it, then you can take a deduction for this donation. Okay. Next is next is if the corporation is following accrual basis method, then this donation which we are making, this will be deducted only if the director approves it, plus contribution is paid before. See, it's accrued, now we have decided to record it in the books, but as and when it is paid before 15th April, it should be paid. It should not happen that in my books I have taken that, yeah, I'm going to make a donation and I'm going to take a deduction. It should actually be paid before 15th of April. Okay, let's look at one example. I guess there are 2 examples. So yes, next will be shareholders ENP, which we'll take in the next session. It will be better. Example is sales revenue is my 7 lakh plus if I have received a dividend income, and my operating expense are 6 lakhs. So my taxable income is 1,80,000. Now, do you remember, if there is a charitable contribution and I'm contributing non-cash property of say 29,000, if it's a non-cash, simply what we will do, we'll just take 10% directly, right? If it's a cash, then it's 25%, do you remember? But here it's non-cash, then we'll just take 10% of the taxable income. That is 10% of 1,80,000, that will be 18,000. But can I take the whole 18,000? Because here you can remember, you can see the dividend income is included. So I'll check the dividend deduction, how much can I get? Let's assume over here in example, it's 65%. So of this 80,000, I'll reduce 65,000 as a DRD, right? It's 52,000. What I'll do, 1,80,000 is my taxable income. Out of that, this is my charitable contribution deduction, and this is my DRD. So whatever is the remaining will be my income. Got it? This type of calculation. Now you know how to use DRD and charitable contribution together. Next MCQ question is, if I'm having a sales of gross sales of 8 lakh, my operating expenses are 8 lakh 15. So I can say I have a NOL, net operating loss of 15,000. So I have received a dividend of 1 lakh. And if I add this dividend of 1 lakh into this NOL, I can say I have a net taxable income of 85K. So what I'll do, I'll check out of this 85K, I'll first reduce my 65K, right? Why 65? 1 lakh into 65%. So is this positive, guys? Yes. If it's positive, then what we'll do two types of calculations. Okay. And whichever is the lower, if it's positive, whichever is the lower, we'll reduce it. See, 85,000. Okay. So wait, guys, here the ownership percentage are different. So I have not mentioned here the percentage, but here they have taken like 50%. So what we'll do, we'll take here 50%. If I take, then here it should be 50K, right? So it's 35K. So it's positive, right? Anyways, it's positive. So 85,000 into 50K, or 1 lakh into 50K, I'll take, that is 50,000. Okay. So what I'll do, if it's 42,500 or if it's 50K, whichever is the lower, that is 42,500, I'll take here as a DRD, and I'll not take 50K because it's positive. See, if I talk about 15K is my loss plus 1 lakh is my dividend, I'll take a dividend distribution of 50K, then okay, it's a positive figure. Got it? Then whichever is lower we'll take. If it's a negative, remember, instead of this positive, it would have been negative, then whichever is higher. Remember this thing. Negative means whichever is higher, positive figure is there, then whichever is lower we will take. Got it? Now you understood the calculation. The next topic is shareholders ENP, earning and profit. This is the second most important topic, which generally people don't understand this topic, or I don't know what happens. They just skip this topic from the syllabus and then go to the exams. This is, trust me guys, this is very simple topic. I've just included it in the book in a very simplified manner. So that don't skip the topic. It's very easy and to understand. So after that, we'll see how to figure the taxes, what type of tax will be applicable. Then we'll see about 1120, 1120S, like Schedule L, M1, M2, M3s. What are the rules and regulations for M1, M3, M2? And then we'll see what are the permanent and temporary adjustments which we are going to make in M1 or M3. Then Schedule M1 reconciliation we'll see. Then how to adjust our book income, and how to adjust the adjustment to reduce the book income. So whatever is the M1 adjustment we'll see. Then I have included few examples based on the previous topics. Then there's the distributions. Okay, so in the next session, I hope I can complete this corporation chapter, because this is the most important and the biggest chapter in the part 2. I can say the partnership and the corporation are the biggest chapters. Okay, so that's it for the day. Tomorrow we'll go through the next topics, starting with the shareholders ENP. So thank you guys. Have a great day.